Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe.
Understanding cash flow statement is one thing, but what happens when the figures aren't readily available? No worries. In this session, I will be working through the CXC Accounting Unit 1 2021 past paper question 3C, a question that requires extra steps including ledger accounts to determine key figures before completing the cash flow statement using the indirect method. Let's get straight into that. Do remember to read your question before you start working. The following was extracted from the books of Thai Limited. Statement of financial position as at 31st of December 2020. Now, remember when you're given cash flow statements to complete, you're going to be presented with 2 years of financial data in respect to that. You need to ensure that you check whether it is the current year that is listed first or it is the previous year. Now, what we're seeing is that 2019, which is the previous year, is listed before the current year, which is 2020. Now, that is important because when you're doing your cash flow statement, you're going to be looking at changes in the cash items. So that would be looking at if there's any increase or if there is any decrease in the items. Now, if it is that you don't realize that the previous year is listed first, or the later year, which is the current year, is listed first, then it means that you're going to be picking up the wrong movement, meaning you may be indicating that there's an increase when in fact there is a reduction. Now, added to the statement of financial position, in order for you to prepare your cash flow statement, you're going to be presented with data from the profit and loss and the statement in changes in equity. And that is presented to us for the period ended 31st of December 2020, which reveal the following. Operating profit is 325,000, three zeros at the top representing that the figures are in thousand. Interest for the year is 17,000 and the profit before tax is 308,000. That is before tax is taken out, which is after the interest was taken. The tax for the year is 77,000 and profit after tax is 231,000. We have dividends paid, transfer to reserves, profit for the year, retained earnings, brought down and carried down. No, during the year ending 31st of December 2020, the company sold equipment costing 60,000 with an accumulated depreciation of 42,000 for $24,000. So what this detail is saying is that the business would have sold an equipment, which is a non-current asset that it had purchased for 60,000. At the time of sale, it had a depreciation, a total depreciation of 42,000. So it would have lost $42,000 in value at that time. But this fixed asset, which is equipment, was sold for 24,000. And that information is crucial when you're preparing your cash flow statement. Now, what is required is that you're to use the indirect method to prepare a statement of cash flows for the year ended 31st of December 2020. And this must be in accordance with Section 7 of IFRS for small, medium enterprises, and that is IAS 7. And we are going to be looking at preparing a statement of cash flow. But remember, in order for you to complete the statement of cash flow, it is divided into three sections. So you need three sections. You need the operating activities section, the investing activities, and the financing activities. These sections help businesses to track how cash is generated and used over a period of time. We're going to begin our response by looking at the title first, because that is the first thing that you are to record. And the title reads Thai Limited Cash Flow Statement for the year ended 31st of December 2020. Having entered your title, you're going to move into the operating activities. Now, for the operating activities, you're going to pick up your profit before interest and tax. You're also going to look for the non-cash items and adjust your profit for that. Then you're going to move into picking up the changes in working capital. Changes in working capital meaning you're looking for increase, decrease in current asset, and also if there's any increase or reduction in your current liabilities. Now, based on the question, we're seeing that the operating profit before interest and tax is 325,000. It did not clearly state operating profit before interest and tax, but notice it comes before taking out the interest and also the tax. So it therefore means that our profit before interest and tax is 325,000. Remember, the figures are listed in thousands. So in our response, we note that net income before interest and tax is 325,000. Now, the other thing that you're going to look for is the adjusting items, such as your depreciation, the gain on sale of non-current assets, the loss on sale of non-current assets, etc. So we're going back to the question to see what we have for depreciation. Now, in the income statement, we're not seeing the figure for depreciation, but we note that in the statement of financial position, there is accumulated depreciation from last year, which is the balance brought down for accumulated depreciation of 320,000. That's at the beginning of 2020. At the end of 2020, accumulated depreciation amounted to 326,000. So those are two figures that we have available relating to accumulated depreciation. But bear in mind as well that the additional information that was presented to us is that equipment was sold for 60,000 with an accumulated depreciation of 42,000. So we have another figure relating to depreciation. Because we have more than two figures relating to depreciation, we're going to use a ledger account to determine the value for the cash flow statement. So the first thing that we're going to do is to create the account for provision for depreciation. And then the first figure that we're going to enter is a balance brought down coming from the previous period. Now, provision for depreciation carries a credit balance. So this 320,000 will be recorded on the credit side of the provision for depreciation account as the balance brought down at the beginning of the period. Now, also presented to us is that there was disposal. Disposal meaning that the fixed asset, the non-current asset was sold. So there was an accumulated depreciation value that went down with that equipment that was sold of 42,000. This 42,000 is going to decrease the accumulated depreciation in the business. So therefore, we're going to debit that value. So disposal is 42,000, meaning the equipment that was sold, that non-current asset that was sold, the depreciation that went out of the business with that is 42,000. So it decreases the depreciation value. The other figure that we have available, and remember, we're working towards determining the depreciation for the year, that profit and loss value for the year, because it is not in the income statement presented to us. So we have to determine it. Now, in this case, we're going to record the balance carried on, which is the depreciation at the end of the period. This balance of 326,000 will then be recorded on the debit side as balance carried down, because our brought down should be recorded on the credit side because the depreciation account, provision for depreciation account carries a credit balance. Now, if you notice, on the debit, you're seeing a total of that 42,000 plus the 326 give us a total of 368,000. That very same 368,000 is the value that should be on the credit side as well. Note carefully that we're now going to find the difference between the two sides to determine profit and loss value. So in this case, we have a total of 368 on the debit, and on the credit, we're seeing a total so far of 320,000. The difference between the 368 and the 320 is going to give us the profit and loss value, which is the depreciation for the year, which is 48,000. This 48,000, if you notice, you're seeing CF beside it, because this 48,000 is the amount for depreciation that we're going to adjust the profit for in the cash flow statement. So depreciation for the year is 48,000. Okay, and we're adding back that non-cash item that was taken out of the profit. The next thing that we're going to do is to look for any gain on sale of the non-current asset or if there's a loss on the sale of the non-current asset. And based on the details that we have available, we did not see it in our statement of profit and loss, but of course we have details relating to that. We have the 60,000 because it did state that the equipment was sold and the cost price of it was 60,000. The accumulated depreciation value is 42,000, but it was sold for 24,000. We now need to determine what is the value, if there is a gain or if there is a loss on the sale of this item, because we need to put in our adjustment in the operating activities section. Now, because we have three figures, we have more than two figures relating to this item. We are going to prepare a ledger account like we did for the depreciation earlier, but this one is going to be an equipment account because we need to see the changes and we need to determine if there was a loss or if there was a gain on the sale of the fixed asset, that disposal of the equipment. So I am preparing an equipment account. Now, in terms of the equipment, remember we were told that the cost price of the equipment is 60,000. So that 60,000 is reported on the debit side of the equipment account because that was the actual value of the equipment at cost, which is 60,000. You could have used cash right here to indicate that that was the cost price of the equipment. No, in this case, remember, the equipment was depreciated. The value of depreciation for the equipment is 42,000. Remember, depreciation is a loss in the value of the fixed asset. So in this case, the 42,000 then will be credited to the equipment account. And we are reporting that as depreciation because it decreases the equipment. No, the other figure that we have available is that it was disposed for 24,000. It means that there was a reduction of that equipment by way of the sale. So when you sell the equipment, it reduces the value of equipment you have in the business. So this 24,000 then is reported on the credit side of the equipment account because that's a reduction in the equipment, and we're going to call it disposal. Disposal because you would have sold it for 24,000. Now notice that on the credit side, you have 42,000, you have 24,000, which give us a total of 66,000. We don't have any other figure relating to the equipment. So what we're going to do is to find the difference between the two sides. And because the credit side is greater than the debit, we're seeing that there is a gain on the sale of that equipment. This gain of 6,000 now is going to be reported in the cash flow statement. And because it is a gain, we are going to subtract that gain. We're taking out that. So we're taking out the gain on the sale of equipment, which is $6,000. Now, when you do the calculation with the adjustments that we don't have any other adjustments based on the question, we are seeing that there is a positive 42,000. This 42,000 is then added to the profit before interest and tax, which is 325,000, and that gives us a value of 367,000. Now that we have taken care of that section, we're going to move into the changes in working capital, which is basically looking at the changes in current assets and current liabilities. For this, we need to go back to the question, and we're now going to look at the difference between last year's figure and the current year's figure of 2020 to determine if there is an increase or decrease in the current assets, and likewise for the current liabilities. But we're going to begin with the current asset first. And we note that for inventory last year, there was a balance of 136,000. And for this year, there is a balance of 170,000. This is an increase in the inventory, increase in the current asset. Because there's an increase in the inventory, it means that there's cash tied up, and it therefore means that it reduces the cash flow of the business. So once there's an increase in the current asset, you're going to subtract. Why? Because it is indicating that there's cash being tied up and it reduces the cash flow in the business. So we're going to find the difference between the 170 and the 136. And the difference between those two figures gave us a value of 34,000. So we are going to less the increase in inventory. Why? Remember, an increase in the inventory is indicating that money is tied up, cash flow is tied up. So it therefore means that there is a reduction in the cash flow from that operating activity. We're going back to the statement of financial position, and we note that trade receivables last year is 109,000 and it reduced to 97,000 in 2020. Now, in this case, it is showing that the debtors are paying up. And because the debtors are paying up, there's a reduction in the current asset. And once there's a reduction in the current asset, it means that cash is coming in. So it therefore means that there's an increase in the cash flow. So therefore means that we are going to add that difference. And the difference between those two figures give us 12,000. We're going back to the question to pick up any other item for the changes in working capital. Note carefully that what we have left for current assets are investments, bank, and cash. And these are cash and cash equivalent items. So it therefore means that we're not going to report these in our changes in working capital. So for the changes in working capital for your current asset, you are going to ignore the cash and the cash equivalent items from that section. So it means that we're going to search for our current liabilities. And we have current liability of trade payables. And bear in mind that you are not going to pay close attention to the tax and the interest because those will be adjusted for when looking at your tax and your interest. But we are focusing on the other current liability items. In this case, we only have one, which is the trade payables. Now, trade payables last year, which is 2019, was 156,000 in balance. Now we're seeing that there's a reduction in the trade payables, which simply means that the business made some payments. And because the business made payment for the trade payables, which is a current liability, reducing its value that is owing, there is an outflow of cash. And in this case, once your current liability decreases, you're going to subtract. And once it increases, you're going to add. So in this case, we're going to subtract that difference, which is basically 156,000 minus 102,000, and that gives us a value of 54,000. And because we don't have any other item that affect the changes in working capital, we're going to calculate this section to see what the changes is. And we have 34,000, which is negative. We have a positive 12,000 and we have a negative 54,000. When you calculate those figures, it gives us an outflow of 76,000 in terms of the changes in working capital. This 76,000 now is then subtracted. It's subtracted because it is negative. It's an outflow. We're subtracting it from the 367,000 and that gives us a value of 291,000. Now, the next thing that we're going to do in preparing the cash flow statement is to look for cash from interest and dividend and tax. Now, we have to go back to the question. To look for the interest, we're going to look if there is any dividend that is received, and we're going to look for the tax that is paid. But we're going to start with the interest. Now, for the interest, in the income statement, you're seeing interest of 17,000. But also note that in the balance sheet, which is a statement of financial position, there are two other figures. Last year, it is showing that interest owing, which is a current liability, is 11,000. And we're seeing that at the end of 2020, there's also interest owing of 8,000. So in this case, we have one figure, two figure, we have three figures relating to interest. And because of that, we need to prepare a ledger account showing the adjustment for interest. And we're going to pick up the balance coming from last year. Because this is a liability, it means that it carries a credit balance, and that is accrued. It's expense accrued, and expenses accrued carries a credit balance because that is a liability. So we're going to report that on the credit side of the interest expense account. Now, the other thing that we are going to pick up is the closing balance of 8,000 that is accrued. And because it is accrued and accruals carry credit balance, expenses accrued carries credit balance, we are going to report this accrued CD on the debit so that the BD can be reflected on the credit. Now, the other figure that we have relating to the interest is the 17,000. And remember, we're working towards getting the amount that was paid for the interest for the year. So this 17,000 is the profit and loss value for the year. And in this case, it is credited to the interest expense account because that is an expense. It was added, it was debited to the profit and loss account. So notice that on the credit side, you have 11,000 and there is a value of 17,000 as well, which gives us a total of 18,000. But on the debit side, we only have 8,000. This simply means that we need to find the difference between the two sides. One side is 28,000 and the other is 8,000. To get the 28 on the debit, it basically indicating that the difference is what we actually paid for expense, which is 20,000. And beside that, I put cash flow because this value is then going to be transferred to the cash flow statement as the interest that was paid. And because it was paid, that is a reduction in cash. There's a cash outflow. So it therefore means that we're going to report that in bracket to show the outflow. Now, the other thing that we're going to look for is the tax. I remember clearly that tax is in the question as well. And for the tax, we are seeing 77,000 in the income statement. And back to the statement of financial position, I recall seeing two figures. So the tax coming from 2019 is showing that it's accrued because it's within the current liabilities, reported in current liabilities. And in this case, it is accrued. Because it is accrued, it means that it is a liability which carries a credit balance. So in the tax account, that value should be credited as the accrued brought down. And remember, we're doing the account because we have all of three figures relating to the tax account. And we have to determine what was the amount paid for tax for the period. Now, the other figure that we have, which is 10,000, we're going to show that on the debit side because this is a closing accrued. And in this case, the CD has to be reported on the debit side in order for the BD to be shown as a current liability on the credit. So on the debit, accrued CD is 10,000. And we noted that there was a value of 77,000 in the profit and loss account. This 77,000 is the actual value for the tax expense for the year. And in that case, the tax account is credited with the profit and loss value of 77,000 for the year, which simply now give us a total on the credit side of $92,000. Now, we also need to get this 92,000 total on the debit. We only have 10,000 so far. So the difference is telling us the amount that was actually paid, which is 82,000, which we're going to report in the cash flow statement. Because remember, in the cash flow statement, you're showing the value that was paid. And we're now going to show that because it was paid, it's also an outflow, and that is reported in bracket to show the outflow. And in total, based on the question, there is no dividend that was received. So we only have the interest expense, the income tax expense, and that gives us a total outflow of 102,000. So that is going to decrease the cash value. And when we subtract that 102,000 from the 291, we note that there is a positive value. And because it is a positive value, we are going to report this as net cash inflow from operating activities of 189,000. And that takes us to the end of the operating activities, which means that we're going to move now into the investing activities. So the investing activities section basically reports cash flows from buying and selling long-term assets, which are the non-current assets, for example, the property, equipment, etc. And if it is that there was a purchase of any of these, then that would cause an outflow of cash. So you would subtract. And if there is any sale of any of the non-current assets, that would mean that there is an inflow because once you sell, you're going to get the cash. So there's going to be an inflow of cash. Similarly, if the business purchase any long-term investment, that's going to be a reduction in cash. So that would be an outflow. And if it is that you're noting that there's a reduction in the investment when you compare the figures from last year and the current year, it means that the business would have sold some investment. So money would be coming in for the business. That would be a cash inflow. Let's move into the question and see what we have available in terms of our investing activities. And the first thing I'm picking up is the sale of the equipment costing 60,000. And in this case, the equipment was sold for the 24,000. It is the actual value that it was sold for that you record in the investing activity. How much money, how much cash did the business get from selling that non-current asset? That actual value that the business received is what you're going to record. And we're going to record the 24,000. And because it is a sale, it means that that figure is an inflow. So we're going to leave it positive. We're going back to the question and we're going to look if there's any changes in the non-current asset, separate and apart from what was sold. So we have the non-current asset, and we're going to focus at the cost price for the non-current asset in this case. So we have one figure right here where the equipment was sold for 60,000, which is a non-current asset figure. We also have from the balance sheet, we're seeing property, plant, and equipment at cost of 940,000. Remember, you're focusing at the cost price, and that is for 2019, a balance of 940,000. And we're also seeing at the end of the current year, a value which went down of 920,000. But we cannot safely say that there was a sale of 20,000. We cannot say that because if you notice, we have more than two figures. And once you have more than two figures, it means that you now need to do some calculation. So we're going to move into looking at the non-current assets account. And we're going to begin by entering the opening balance. And the opening balance is coming from 2019. Remember, that was 940,000. Let me give you a look at that again. So in the question, 2019, the cost price for the non-current assets total 940,000. The 920,000 is at the end of the period. And in this case, it is a balance carried down. And because this is a non-current asset, assets carry debit balance. So we're going to report this 920 as carried down on the credit so that the balance brought down can be recorded on the debit. So that is our balance carried down. Now, the other thing that we need to ensure that we record in our non-current asset account is the fact that the non-current asset went down by 60,000 in cost price. We're focusing on the cost price. So remember, the equipment cost 60,000 and that was sold. So once you're selling the asset, that's a reduction in the asset. So therefore means that you have to credit. And this figure is recorded on the credit side as disposal because it was sold. Now, having recorded that, you're seeing on the credit side now a total of 60 plus 920,000, which gives us 980,000. So having entered the three figures, the credit side is saying 980,000. The debit as well must be reporting 980,000. The difference now is going to give us the increase in non-current asset, which means that the business would have spent to get that. And that difference is 40,000. Now, because the business spent to get that, we're going to report that in the cash flow statement as an outflow from that investing activity. So in the cash flow statement, we're going to report purchase on non-current asset. How do we know it's a purchase? Because the difference was on the debit side, which means that there was an increase in the non-current asset. And that value was 40,000. Now, because it was a purchase, it means that there's an outflow of cash. So therefore means that we report this in bracket to show the reduction. There's another thing for the investing activity. And we note that the investment. So when you look at the statement of financial position, you're seeing investment of 215,000 for 2019. So that was the balance from 2019. But at the end of this year, you're seeing, which is 2020, you're seeing the balance increase to 253,000, which simply means that because there's an increase in the investment, the business would have purchased, the business spent some money in getting some long-term investment. So there's an outflow of cash on the investments. And we're going to find a difference between these two figures. And this gave us a value of 38,000. That 38,000 is reported under the investing activities, and it is in bracket because it is an outflow. Those are the only three items we have for the investing activities. So in this case, we are then going to calculate the value from investing activities to see if there is an inflow or an outflow of cash from the investing activities. 24, which is positive 24,000, minus 40,000, minus 38,000 is giving us a net cash outflow from investing activities of 54,000. And having looked at the investing activities, we're now going to move into the final section, which is the financing activities. In the financing activities section, it tracks cash flows relating to funding the business, including the sale of stock, borrowing, repaying debt, and even distributing the dividends to the shareholders. So we're going to look in the question for that details. If it is that the business, there's an increase in stock. If there's an increase in stock, it means that the business would have sold stock. And in selling the stock, cash is coming in. So that would be an inflow. We're going to look if there is any repayment of any debentures, etc. So let's go to the question. And we're checking in the statements of financial position, and we note that ordinary shares in 2019, the end of 2019, it amounted to 650,000. So that was a balance in the ordinary share capital account. But at the end of the current year, which is this year, we're seeing 700,000. So there is an increase in ordinary shares. So it means that the business would have issued shares, and the difference between these two figures give us 50,000. So the sale of the shares caused an inflow in financing activities, and the difference is 50,000. That is reported as a positive. We're going back to the question to check if we have any dividend that is paid, and also if there is any reduction in the debenture, etc. So let's go. So in the question, we are seeing that dividends paid, which is coming from the income statement, dividends paid, 26,000. This dividend that is paid is an outflow. So it therefore means that in the financing activities, we're going to show that in bracket to show that cash went down. There was a payment of dividend, and that reduces the cash. So there's an outflow of cash. So that is reported in bracket of 26,000. Back to the question, we are going to look, double check in the statement of financial position if there is any long-term liability and if there is an increase or decrease. So we are noting that there is a 10% debenture, and last year's value is 170,000. So because this year's value is lower than that of last year, it means that there was a payment of the debenture, meaning there was a redemption of the debenture. There is a reduction in the value that is owing on the debenture. So it therefore means that there is an outflow of cash. In this case, having find the difference between the two figures, it is 72,000 as an outflow for the redemption of debentures. When you redeem debentures, it means that there's a reduction in the value that you're owing for debentures. And those were the only items for the financing activities. And in this case, we are now going to calculate. So it's a positive 50 minus 26,000, and we're subtracting 72,000 from that as well. And that gives us an outflow from financing activities of 48,000. Now, we are at the stage where we're going to calculate the inflows and outflows from the three sections of the cash flow statement, where operating activities was an inflow of 189,000. There is an outflow from investing activities, so we're going to minus that 54,000. And there's also an outflow from the financing activities of 48,000. Having calculated those, we have an increase in cash. We say increase in cash because it is a positive figure. If it is that having calculated it was negative, it would have been a reduction in cash. And we can say in cash and cash equivalent. Now we are going to go to the question and we're going to pick up our opening cash and cash equivalent value. Based on the question, we have investment, which is a cash equivalent item of 23,000. We also have bank, which is a cash equivalent of 80,000. And we have cash of 40,000. We're going to add those figures together, and that give us a total opening cash and cash equivalent value of 143,000, and we're going to add that figure. So that should be add opening cash and cash equivalent, because in this case, we have the investment that is included in that and the value from bank that is also included in that. Remember, when you add those three figures together, you get a total of 143,000. Now, once you add the opening cash and cash equivalent to your increase in cash, you're now going to get the closing balance in cash and cash equivalent. So this is ending cash and cash equivalent. And we are going to double check that value. We're seeing where it is 230,000, having added the opening balance of 143,000 to the 87,000. Let's go to the question, and we are going to check in a statement of financial position on the closing cash and near cash items, which are the cash equivalent. So we have investment of 50,000. We have the bank of 118,000, and we have 62,000. When you add those three figures together, you get the total of 230,000. So we can safely say that we would have completed the cash flow statement accurately using the indirect method for Thai Limited. And remember, we had to prepare the ledger accounts. Why? Because once you're working with an item and you have more than two figures relating to it, it is safe for you to complete the ledger account so that you can determine the value that you place in the cash flow statement. So remember, it's not hard to prepare a cash flow statement. But when it comes on to determining the value because you have more than two items relating to it, you have to be very careful. So remember, look if you have more than two values relating to a particular item. Once you have more than two values, you have to prepare the ledger accounts to determine the value that you put in your cash flow statement. And that takes us to the end of completing the CXC Accounting Unit 1 2021 past paper question 3C.
Like, share, and don't forget to subscribe.